Is in control of our weather. Do expect mostly sunny skies throughout the day today. Maybe a few passing fair weather clouds. Highs into the upper 40s. Heading into tonight, mostly clear skies. Overnight lows right around 30. And then heading into your Monday, lots of sunshine with highs in the low 50s. From the CBS 21 First Warning Weather Center, I'm meteorologist Chris Nell.
27 degrees at WHP.
David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm. It's now time for User-Friendly Finance with Dave Weaver from SWC Wealth Management on News Radio, WHP 580. If you have a question for Dave, call 540-0580. Now with today's show, here's Dave Weaver.
Hi, good morning. This is Dave Weaver with SWC True North Wealth Management and bringing you user-friendly finance as we try to go through the different issues that affect your financial situation and your personal financial life. We are kind of walking through what we call our 8 wealth management issues. Joining me today is Megan Wall, who is typically in our Carlisle office. How are you today, Megan?
I am doing well. Good morning.
Well is good?
Mm-hmm.
Okay, good. It was kind of a bummer this past week. It's hard to believe at this point in time that we had to cancel our seminar because there was too much snow. The library was closed. A lot of Carlisle was shut down. A lot of businesses were shut down. And now we're looking at clear roads, clear skies, all is good. Spring has sprung.
I don't know. It's 28 degrees.
Yeah, so it's still a little bit cold.
It's springing. How about that?
It's springing. So we're rescheduling our seminar. We postponed it. I think it's a date in April. I think it's April 21st, but I'm not positive. We'll come back with more information about that. We're
Closer
also
to the date.
Yeah, a little closer to the date, probably after the first or second week of April. We'll start talking about that again. And we're also going to have a PSER seminar for members of the teachers, various educational institutions we have around Pennsylvania for teachers and employees of the public school system. We had a couple of retirement seminars last year that I thought were really good. We have Mary James, who is a former regional director with PSERS, who works with us, is on our staff, and she is extremely knowledgeable about PSERS. If you know anybody who's gone to our previous seminars, you know that she's got an extremely deep amount of knowledge in that entire subject.
She really does. I have been very impressed with her explanation of all the options that people have and also helping them find benefits that they may not have known they were entitled to, health insurance benefits and otherwise. So I would definitely recommend if you have the ability to attend one of those and you're part of the education retirement system to check it out.
Right, and if you check out our website and look at her biography, it's pretty incredible. Just the background that she's had and the fact that she's working with us, I think, is a great thing. We're really happy to have her on board on our staff. So she can definitely help if you're a member of if you're a teacher considering retiring either in the early summer or late in the year. She's absolutely a great resource to help you out. And if you have any questions and don't want to attend our event, you can give our office a call at 717-7060-700 and reach Mary. And we have a couple of other things that we're going to be doing over the course of the next couple of months. A couple more PSER seminars. We're going to do another one of those. Or like we're having to reschedule the retirement seminar. We're going to give people who didn't sign up another chance to sign up if you're interested. And that's really not about, I think we tried to mention and emphasize the last week that it's not there to try to intend to sell you anything. It's trying to just get you to help picture the retirement that you want in line with our True North Wealth Management concept that we're trying to implement and bring forward to help you plan a retirement that's good for you and is in line with what your personal goals and objectives are.
Absolutely. So the workbook and the seminar really work towards helping you find that picture and start figuring out what you have to do actively in order to make sure that happens, because sometimes people forget how difficult that going from the saving to the spending and enjoying can be whether that's the difficult part, whether the not having somewhere to go every morning at 8 a.m. is the difficult part. But there are a lot of adjustments that you need to make. So it's important that you really try to picture how you want that life to look, and rather than just letting it happen to you, because you may not enjoy it as much as you could.
Yeah, when you're young and you spend 35 or 40 years working, it's very seldom, we talked about this before, it's very seldom that your lifetime retirement goal is to just sit and watch TV all day. You know, there's other things in life. Maybe TV is what you want to do, but if it's not, and you have other things you want to try to accomplish in your retirement, when you have more time to be able to do the things you want to do, find things that you actually want to do. And TV isn't, you know, it's okay, but, you know, 24 hours a day, it gets a little old.
Absolutely. And we're not
That'll make a long, drawn out retirement.
Dave likes TV too.
Like
he
TV
just doesn't want that to be the whole picture. You worked hard and saved hard for a reason. So we just want to make sure that you get where you want to be.
Right. And you work hard for your retirement. 35 to 40 years is a long time to put in. So you want to get the benefit of everything that you worked for. We're continuing today as we walk through what we call the 8 wealth management issues at HD Vest. And we've been through quite a few of them. So far, we've talked about investment management, which is actually how you allocate or invest your mutual funds or stocks or bonds, whatever you're invested in. Cash flow and debt management, which is really more typically how you compile your budget, how you work, how you put together what you're spending your money on. And a lot of people aren't that good at that. We do a lot of shows on that because we think it's really the core of how you're going to live your retirement. If you understand that budget, you can probably get by with less money than you think and still have a really happy, enjoyable retirement.
Absolutely. And I think it is important at any income level, just because it's just basically taking a snapshot and making sure the money goes where you want it to go. So you're going to work for it. If you want it to go to Starbucks coffee and you can afford that, there's absolutely no problem with that. It's just making sure that it's going towards the things that you want it to go to, rather than just, I think most of us know if you have, $25 in your pocket, it's gone before you know it, unless you decide what you want to spend that $25 on. So
yeah, I'm not a good cash person myself, so I definitely have to limit my cash and know how much is going to cash. The average person, you're right. We just talked about this with somebody last week. If you're making $20,000 and you're used to spending that, that'll be the number that you're spending. If you have 50, you'll find a way to spend 50. So you just have to understand what the budget is, give yourself access to that amount of money, and try to keep the excess to supplement that.
Absolutely.
And we believe that a couple married couple with their house paid off and very little other debt can probably live on about $35,000 to $36,000 with a low frills or moderate lifestyle, nothing super extravagant, not a lot of big expensive cars or house at the beach or whatever.
So if you are worried about whether you can make it, it looks, and that is $36,000 after tax, not before tax.
Yeah, sorry.
But if you're worried about reading out there, you need this exact amount of money to retire. We have people who live that lifestyle, and we have people who have a budget of $200,000 a year after
$40,000 or $50,000.
So,
we have a lot of happy clients at $40,000 or $50,000 a year in retirement.
In fact, I'd say even ones who have quite a bit of savings that could afford much higher live around in that area as far as our clients go.
Yeah,
so
as far as the happy people.
Absolutely. There's a little bit of everything, and it doesn't look the same for everyone.
Okay, with that, we'll take a break. We still have to sort of explain what the 8 wealth management issues are again, and then we'll cover a topic today, which is going to be business planning, and which is more to deal with retirement plans and how a business can plan for retirement. This is Dave Weaver and Megan Wall with SWC True North Wealth Management, bringing you user-friendly finance, and we'll be back right after the break. Okay, this is Dave Weaver and Megan Wall back with user-friendly finance from True North SWC True North Wealth Management. I didn't give your contact information. If you want to give us a call during the week, our number is 717-706-0700, or you can reach us via the web at swcwealth.com. Our two offices are located in Palmyra and Carlisle. In Palmyra, we're at 103 West Main, and in Carlisle, we're at 35 East High. Both are about a block off the square, so very easy to get to. But again, probably the easiest thing to do is call and try to schedule an appointment. If you have any questions as we're going through the show today, you can call us at 717-540-0580 or 800-724-5801. And we have those $10 Panera gift cards, which we will soon have to we'll change that to something else soon.
Yeah.
Maybe Five Guys, something like that. We'll see.
They are popping up all over. That might be a good choice.
I do like Five Guys. Okay, so again, we're covering the 8 wealth management issues, and we talked about debt management. We talked a little bit about family risk management, which is typically things such as long-term care, life insurance, etc. We've touched a lot of times on retirement planning. Last couple of weeks, we talked about education planning. We haven't talked specifically about estate planning. We're probably going to have an attorney come in here and help us talk about that. Today, we're talking about business planning. And then our 8th wealth management issue is special situations, which are just various things like we were just talking about in retirement. If you want to plan for specific things such as a vacation property, an RV, planning for a wedding, all those things are things that you need to save for, and how do you go about the process of doing that? So today we're going to talk about business planning, and what we're going to primarily focus on today are different types of retirement plans that you might have. If you're a small business owner, if you don't have one, I would definitely consider starting one. Mm-hmm. We have a lot of small business plans that we work with for simple IRAs. And what we find is a lot of people don't even know what type of plan they have. So,
yeah, even a lot of times people will call in who have a simple IRA and be talking about their 401k and things like that. So it's seemingly unimportant because from a high level perspective, the money you put in there is before tax money. When you take it out, it's taxed. That is similar about all of these retirement plans, but there are different rules for withdrawals from different plans, different contribution limits, and things like that. So it is important that you do realize which type of plan you have. And if you are the business owner, it's important that you evaluate which plan is going to be best for you and your employees.
Yeah, so we're going to talk a little bit about both the employee and the employer aspect of the different types of plans. And again, what we find is a lot of people don't have a good understanding of what plan they're in, or that there are different types of plans. The size of your company has a lot to do with it, and how profitable they are also has a lot to do with it. A lot of people are most familiar with a traditional 401k plan. Those are the first ones that were implemented. I can't even remember what year they started, probably in the mid-'80s is when they were first implemented, maybe a little bit before that. And
it's hard to believe that it's only been that long.
I know.
But pensions used to be all over the place.
Yeah, we have 5 different types of plans we're going to talk about today. One of those is the defined benefit plan that Megan's talking about. And back in the day before we had 401ks, virtually everybody who had a retirement plan had one through a large employer and employer plans. And what happened with those plans is the employer would contribute the bulk of the money into the plan. When you went to retire, the employer had put aside that money, and it was going into a separate pool of money, separate from the assets of the company. They would give that money to an insurance company. The insurance company would calculate your life expectancy, give you a pension that would be good for the rest of your life based on the amount of time from the time you started collecting till the time you were projected to pass, and that's the amount of money that you got. And if you got it, you had it for a lifetime. Originally, you did not have the ability to pass it on to your spouse. As they went through time, they had different options for continuing those benefits on with your spouse. And when we talk about 401ks, they're very similar to a 403b, which is typically for employees of universities and nonprofits for the most part. And a lot of the rules are same. They have some differences, but we were going to talk primarily about 401ks today. So
can I say one more thing about a defined benefit?
You can absolutely say one more thing about a defined
one,
benefit plan.
One more thing. If you have a pension at your job right now, you know often there is a mandatory amount that you have to contribute. There's usually, you could have the ability to contribute more, but there usually is some amount that you are mandated to put in that your company is also matching.
In a defined benefit plan.
Yep.
Okay. So, again, a lot of people, if you're in a larger company working for a large employer, you'll have either a 401k or a 403b. They have high deferral limits. They typically have a lot of flexibility. The employer decides what the plan rules are. A lot of people think that the IRS defines the rules for every single plan, and it's really not the case. The employer has a laundry list of probably 25 or 30 different check marks that they can make, which will define how the plan actually operates. So,
yeah, so the IRS is more focused on the tax part of it, but there are, the owner of the plan can decide to allow withdrawals and loans and how much they're going to allow of those. They have a lot of leeway. And it's not something that you would normally change. So you may be working for a different employer than the person who actually originally started the plan. So don't think that your employer has a rule there against you or something like that. A lot of times these plans were set up and then they're just continued the way that they were originally set up.
And the employer has discretion over whether they make contributions for the employees or whether they do an employee match. And again, all these various rules for the plans, people assume are the same everywhere, but they're definitely not. The employer match is at the discretion of the employer, and there are limits where they can't go above. But they're set by the employer, and a lot of times based on the profitability of how the plan's doing. They change year to year. I think in October, November, they have to notify you what the plan rules are and how they've changed for the current year. Some of the different things Megan touched on are, does the plan offer loans? Not all plans do. The employer has the option of offering that or not offering that.
And they have the option with a 401k, but for a simple IRA, they're never allowed. So There's some caveats there.
Yeah, there's some definitely difference in the rules. They'll have limits on the ability for how you can get money out. Some plans don't let you get the money out of your plan until you retire. Some plans allow for what they call an in-service withdrawal, meaning if you've attained a certain age, you can get money out and roll it into your own IRA or take it out for various reasons. They'll specify which reasons you can take money out of your plan.
Mm-hmm. And one common thing is if people work until later, but they do want to have access to some of that money because they're over 50, often the age is 59 and a half. So they wouldn't have a penalty if they wanted to use some of the money that's within their 401k. So a lot of times people will roll it into something that either secures an income stream for them down the line or gives them a little bit more accessibility to that money.
Exactly. And those rules are typically, they'll have to do with the either the normal retirement age of the company or 59 and a half when you can get money without taxability, or when you're either retire or sever service. So the employer has a lot more discretion than what you think in setting up the plan. But once the plans are there, they're in place for the duration of the plan until they actually make a plan change, notify employees. They have to do that formally and in writing to be able to make changes to the plan. They can do that on an annual basis. I think
and if you don't hear anything, that means they probably didn't make any changes.
And normally once the plans are set, they don't really change too much. 401k will also typically give you now a Roth deferral option, which means in a traditional 401k, when they first started, you could only make deductions that reduced your taxable income. The money that went into your 401k was eventually taxed as you took the money out. The employer's match was always in that type of plan. It's a deduction for them, and the money went into your plan, but then was eventually yours with whatever rules are for the plan that allow you to take the money out.
Yeah. So if you, even today, if you have the Roth option, which again, the traditional 401k is before tax. So in the future, when you take out those dollars, everyone will be taxed. Whereas the Roth option does not lower your taxable income now. You don't get a tax break now. It's after tax dollars. But when you take money out of the Roth part in the future, it's tax free. If you say you had a 3% employer match and you did the Roth option, if you decide to roll it over in the future, when you roll it over, you'll have to actually have two accounts. One would be a Roth IRA and one would be an IRA.
Yeah,
Most
the
likely,
employer's
almost
matches.
all employer matches before tax dollars because that's how they get their tax benefit in giving you the money. So it's good for them, but no, it's also a huge benefit for you that they're putting the money in there as well.
Yeah, the employer match is always in an IRA type of account. Well, with that, we'll take a break, and we'll be back. If you have any questions, give us a call, 540-0580 or 800-724-5801. This is Dave Weaver and Megan Wall with User Friendly Finance from SWC True North Wealth Management. Hi, this is Dave Weaver and Megan Wall with User Friendly Finance from SWC, True North Wealth Management. And we're talking about the subject of employer plans and the various plans that might be available. If you're an employer or an employee going to a new employer, you may have a different plan than what you had before. And there are a lot of different plans. A lot of people aren't aware of all of them. And when we took the break, we were talking about 401ks, the traditional 401k that a lot of people have if you work for larger employers. That covers a lot of the working world. And in our office, we have what they call a solo 401, not a solo 401k. We have a 401k, but for a small business. So it works the same as one for a large business. There are solo 401ks that are available if you have just an employer and a spouse, or an employer spouse and maybe just their child with no other employees.
And the reason why you would want to do, one of the reasons why you might want to do a 401k rather than a traditional IRA, as we mentioned, was the higher deferral limits. So the regular 401k deferral limit for 2018 is $18,500 if you're under the age of 50. And if you're over the age of 50, you can contribute an extra $6,000. So when you're comparing it to a traditional IRA or a traditional Roth IRA that is not held within a 401k, those contribution limits are $5,500 if you're under 50, an extra $1,000 catch up if you're over the age of 50. So as you can see, there's a very large difference.
And even if you're in a simple plan, which is typically used for a company that has 100 or fewer employees, the limits are, what are the limits for that?
$12,500 if you are,
and then an extra $3,000 of catch up.
Mm-hmm.
So those are some of the reasons that employers may have different kinds of plans. But again, we were saying in a 401k, you have a Roth deferral option, meaning you have and some employers let you split that between a Roth and traditional. Some you have to pick Roth or traditional. A lot of times with a 401k, there's what they call a vesting schedule. And a vesting schedule means that the employers match. Your money is always yours for all the types of plans we're talking about. But in a vesting plan or vesting period schedule, the employer match gradually becomes yours over time, and they can pick the amount of time for the vesting schedule. The IRS doesn't define those rules. They have there's a range of times. There are limits that you can't go beyond, but generally it's either 2, 3, 4, or 5 years that the money becomes yours, and a lot of times what happens, and they can pick the percentage that becomes yours over time.
Yeah.
But in a 4-year vesting, you might get 25% of their money becomes yours after the first year. Then after the second year, it's up to 50%, then 75%, then 100% over the 4 years. It just depends on the rules that the employer has set up.
And again, that's only for their contributions to the plan. So your contributions are always yours. Some people don't like the idea of a vesting schedule, but the employer wants to protect themselves so that they don't have employees who come and work for them. They put money in the plan, then they leave and take the money with them. So they want to help ensure that they're going to retain good employees. And this is seen as also a way to help a small business retain a good employee, because that is a wonderful benefit that you are being offered.
Right. Another aspect of a 401k is always a third-party administrator to help make sure that the plan adheres to the IRS rules, because the rules are complicated. There are a lot of ways that you can go amok, and that would screw up their tax-free nature of their match if they have a match. So
Absolutely.
There's a third-party administrator that helps them make sure that they play by the rules and understand the rules. And also, if you need a loan or anything like that, typically that'll eventually go through the third-party administrator for administration of that. The loan options we talked about, typically you're allowed to borrow up to 50% of the assets of the plan. A lot of times you can't have more than 3 loans running concurrently, and I think they have to be paid off within a 5-year period, each individual loan.
And they can make it 50% of your contributions, or it can be 50% of your contributions plus the vested balance. So,
and a
or
lot
50%
of times,
of the vested balance. So that's for if you have a loan out on your 401k. And some plans don't allow you to take loans. They do have the ability to make it so you can't take any loans. It's just very common with a 401k to allow loans.
And when you borrow money from your plan, you're paying it back to yourself at a named rate of return. They'll tell you it's either based on some kind of an index or a specific rate, but the plan rules also define that. It's typically not a good idea to borrow from your plan. You can do better with your assets by actually keeping them invested. It's very tempting to not pay it back if you have a certain period of time to pay it back because you think it's your money. If you leave an employer, those loans have to be typically paid off before you can transfer it to another plan. Some in 401ks, if you change employers and stay with the plan, will let you continue your loan. But typically, if you leave employers, get out of your 401k, you'll have to pay back the loan, or it becomes a taxable event. And potentially subject to a 10% penalty if you're not 59 and a half.
Absolutely. And one
a lot
more
of rules.
One more thing about the 401k is that often there's testing required at some. It can be up to annually, just to make sure that the plan is being administered fairly and proportionately for employees. So that doesn't mean that every employee necessarily has the exact same benefit under the 401k, but it has to be based on a difference. So you can't have 2 people with the exact same job and one being given money in their 401k differently than the other. So there is a third-party administrator, and there is someone making sure that that's being taken care of. And part of that is because, honestly, think of all the small businesses that are out there, and the things that you're specializing in is often not 401k administration. So it's nice that there are checks and balances there to make sure that everything's being run correctly.
And again, those assets are supposed to be a separate asset from the assets of the company. The monies the employers are putting away on your behalf are typically held somewhere other than with them. Well, they have to be held somewhere other. It's not a plan asset. There are assets that are eventually going to somebody else. So
if you do leave behind your 401k at your old employer and then you want to take money out of it, they will have to sign off on that often. So that's one reason why some people prefer to roll it into their new plan or a different plan.
Right. Another type of a plan, probably the most common one that we deal with, because a lot of times we're dealing with employers that are fewer than 100 employees, is a simple IRA. And a simple IRA, it's not subject to the IRS testing and reporting requirements. With a 401k, there's a form called a 5500 that has to be submitted annually. In a simple IRA, that doesn't have to be done until the plan assets hit $250,000. But typically with a simple IRA, the employer has 2 choices. They can either provide a 2% contribution to everyone in the plan, regardless of whether they sign up for it, or they can do up to 3% for people that submit or participate in the plan.
So if you put in 3%, they would match 3%. If you put in 2%, they would match 2%. If you put in 8%, they would match 3%. So it's an up to 3% match.
Yeah, so it's up to 3% or 2% for everybody, regardless of whether they contribute. Those contributions that the employer makes are a deductible business expense for them. And what that helps them to do is it helps you as an employee have money that's going to your retirement plan that you didn't have to participate, or that you didn't have to provide, and for the employer, it's a business deduction. So, with that, we'll take a break, and we have a question we'll try to pick up after the break. This is Dave Weaver and Megan Wall with User Friendly Finance and SWC True North Wealth Management. Hi, this is Dave Weaver and Megan Wall with User Friendly Finance from SWC True North Wealth Management. And we're going to pick up Michael. Sorry, Michael. I didn't see that you had called in and before the break, so we'll pick up your call now. Michael, how are you doing today? Oh, hey, Michael's gone. Wow.
Sorry,
that's my
Michael.
fault.
Call
Sorry,
back
Michael.
if
Yep.
you would like to, or
Okay.
you can shoot us an email or call us during the week.
Right. And our phone number, by the way, again, is 717-706-0700. Thanks, Megan. And
Our website is swcwealth.com.
swcwealth.com. True North. It should be True North at some point. Maybe it will be. Nope. Okay.
We're
Anyway.
keeping it short
We're keeping it short.
for now.
And we're also working on trying to we're soon going to have a new location in Carlisle, hopefully in about a month or so. We think our website is done. Now that our website is done, we're going to have to change everything so we can put our new address in. But we're moving a couple blocks away from where we're at now. But it should be a nice location. We're really looking forward to that. And we'll probably at some point have some kind of a grand opening.
Yeah, we're just deep in the throes of renovations.
Yeah, deep in the throes of renovation. So in our plan, we have a 401k, and I really just went to that just to increase the limits. Oh, there's Michael back, so we should probably pick him up. Okay, Michael, sorry about that.
Things happen. Good morning.
Good
morning.
morning.
I had a question. You were talking about IRAs, 401. I'm at the other end of the spectrum. When I retired, I rolled it over in an IRA.
Okay.
But now I'm close to the age that I have to do something.
Oh, you're 70 and a half, or almost 70 and a half.
Close to it. But I don't know how much. How do you know how much to take out? I know you're required to withdraw so much every year.
Yeah,
And when does that start? When you turn, you only do your taxes once a year. But
yeah, so what happens with a required minimum, it's called a required minimum distribution, and you have to start taking that the year that you turn 70 and a half.
oh, the year you turn 70. Okay.
Right. So not the year you turn 70, but the year you turn 70 and a half. I don't know how they figured that out.
Yeah.
In their infinite wisdom, the IRS has picked another random date. But in that year that you turn 70 and a half, you have the option of taking that or not taking that. Almost everybody takes it because if you don't take it, because if you don't take it the first year, you have to take two the second year. So it's approximately 3.6% of the balance.
Oh, that's not too bad. I
No,
thought
it's not
maybe
too
like
bad.
10% or something like that.
No, it's 3.6, and the
Goes up
percentage
each
gradually
year.
increases as you get older based on your life expectancy. So
Well, how do you know it? I mean, you told me 3.6, but how do you know every year since it changes? Do they have
So-
a
Are you-
table or
yeah, are you internet savvy?
so-so?
So. Well, if you would do like a Google search on required minimum distribution table, there are some of them that are out. There are tables that are out there that'll help tell you. And typically, if you have an IRA, just about anywhere, they'll notify you in the beginning of the year that you're required to take
Oh,
one
they
and
do.
what the amount is.
Yeah, because it's based on December 31st value.
Oh, I
So usually once they get that value, then the next year they'll send out the letter.
Now,
and
you
if
have to
you-
take if you have 3 IRAs, do you have to take them out of all 3, or is it just one?
You
You
can
can-
take one amount but it's based on the value of all three, but you have to take.
You can take it wherever you want.
Yeah, you can either take it all out of one. You could take it out of two different ones, but you have to take 3.6% of the value of all three on December 31st of the year prior to the year that you're taking it.
So
And that's when you pay taxes on it.
Correct.
Yeah, you can either have it withheld or pay it when you pay your taxes, but
Oh, I see.
it'll be in that tax year that you actually take the money out.
The only way that you could not pay taxes on it is if you had it go directly to a charity.
I'm sorry, go directly.
To a charity. So if you have
I
the
see.
check go directly, then there's no tax consequence. But other than that, you do have to pay tax on it. And one reason why people might take it from all three rather than one is sometimes people just don't want to have to remember. So you can set it up with each company that they just automatically do it if it's based on the account that's only held with them.
Oh, okay.
So it depends. For instance, we have some clients who may have it part of their IRA in an annuity, and that has a guaranteed roll-up amount. So they might not want to touch that for 2 years or something. So in that time they may take from a different IRA. But it's different for each situation. But that's one reason why you may want to do it from each rather than just one.
Yeah, just the fact that you have three sometimes is enough reasons for people to combine them.
Mm-hmm.
Because then they don't have to keep track of 3 different IRAs. They only have to look at
more
one.
simple.
Yeah, it makes it more sense. And some people have, it's still, with a lot of people changing jobs over the last, 10 or 15 years, a lot of people have 3, 4, 5, 6 IRAs. Or, I talked to somebody the other week that had done individual IRAs every year in CDs. That is at all different banks, all as they come due. They're going around trying to find the best rate at any point in time. So they're all different banks all over the place. And that's incredibly messy when it comes to RMD time. How do you keep track of it? It's just a mess.
I see.
But,
okay, well, thanks for the information.
Yeah, if you stay on the line, Art will give your information for a Panera gift card.
Okay, thanks, and I enjoy your show very much.
Oh, thank you very much.
Thank you.
Okay, have a good day.
You too. Okay, so we're talking about simple IRAs and IRAs in general. And
a simple IRA, I think we said the maximum contribution amount was $12,500 with a $3,000 catch-up.
Yeah, and most people don't do, just like in a 401k where the maximum is $18,000. Most people don't do $18,000.
And often, if people do get to that point, they didn't start off at that point. So I know some people who maybe, graduated from college and got a job that could sufficiently cover all their bills. And then as they got raises, whatever the amount their raise was, they just added that point to their 401k. So over time, by the time they've worked there 35 years, then they're getting to the max. So it's not unheard of for people to max it out, but that's not something that you necessarily need to feel worried that you're not doing.
Right. And again, with a lot of times when we talk to people about just retire or planning for retirement in general, we will almost always say, have you maxed out your employer plan at work? Meaning, have you at least done what the employer matches? Not so much have you maxed out your plan, but are you at least doing the match up to the point where your employer matches? If not, then maybe if you've done that, then maybe to the point where you can do the max, and then you look at other things beyond that, maybe a Roth IRA, and then maybe some kind of LIRP or life insurance retirement plan. There are various ways that you can do more and more saving as you want to try to do more saving.
But again, that's for people who have income higher than their expenses, or significantly higher if they get to that point. But you want to make sure that you do as much tax savvy saving as you can.
Yeah, and that's the whole key, is trying to plan for a good retirement. Back to, the purpose of the seminar we're trying to have that got snowed out is how do you actually save for the retirement that you want? The another type of plan is a profit sharing plan. A lot of times that's part of a traditional 401k. Sometimes that's the only plan that some employers offer is something that's based on profits. What a profit sharing plan does is allow the employer to share just a percentage of profits. The contributions are discretionary. They can also have a separate vesting schedule than the traditional 401k contributions have. There are a lot of times administrative costs, and there's complicated reporting if you're an employer wanting to implement something like that. And there's also testing to make sure that it's offered fairly across all the employees.
Mm-hmm.
So it's when you get to the point of trying to figure out what kind of plan you want, a lot of times it makes sense to consult a professional. A financial advisor will be able to tell you the different kinds of plans, who some of the various providers are. There are a lot of companies that provide 401ks, simple IRAs, profit sharing plans. All those have various means of allowing you to try to save and plan for retirement.
Absolutely. And some benefits additionally for these plans are that the cost of the plan is can be, if it's a 401k, the cost of the plan can be shared somewhat by the number of employees. And if it's a simple IRA, you get a discount on the sales charge for anything that's held within that plan because it counts all your assets together. So there are some good benefits in investing within a plan at work.
Yeah, so
from a cost standpoint.
So just quickly, some of the things, because I think we're going to run out of time, but some of the advantages are that the employer contributions are deductible from their income, the employee contributions aren't taxed until they're distributed, and the money grows tax-free for you until you actually take it and the money's distributed. So with that, we've covered a lot of what we wanted to try to cover with the types of retirement plans that are available. Thanks again for listening. This is Dave Weaver and Megan Wall with User-Friendly Finance, brought to you by SWC True North Wealth Management. Give us a call, 706-0700, or via the web at swcwealth.com. Thank you very much for listening.
David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm.